this is where we're headed in terms of an uptrend.
Watch Yorba.tv with Michael Yorba.
Right now, we still have a liquidity crunch.
A new network for the serious investor.
Indicators have to complement each other.
Yorba.tv.
There's good news on the horizon.
Cutting-edge information from the trading floor.
Commodity markets are pretty much in a frenzy.
Live on the web at the closing bell.
Record high in crude today.
Weekdays, 3 to 4 p.m. Central on Yorba.tv.
The risk of loss in trading futures and options can be substantial. Therefore, only genuine risk funds should be used in such trading. Futures and options may not be a suitable investment for all individuals, and individuals should carefully consider their financial condition in deciding whether to trade. Option traders should be aware that the exercise of a long option will result in a futures position. Information herein has been obtained and prepared from sources believed to be reliable. Comments contained in these materials are not intended to be a solicitation to buy or sell any of the commodities mentioned. Past performance is not indicative of any future performance. Opinions expressed here are the opinions of the author only, and not the opinion of any firm the author may be affiliated or associated with.
Welcome to Commodity Classics. I'm Michael Yorba, your host. Thanks for joining us today. My first guest is Tony Chernowski, Chief Investment Officer of The Practical Investor. But before we bring in Tony, I wanted to tell you a little bit about some things that have come up on the shout box right away about Tony. Toreador, I can't roll my R's like I should, but he says kudos to Tony for being one of the very few analysts to call the market correctly. And then he goes further in another statement. It says, Tony and Mish was on our show, I think it was about the first or second, maybe the third week, are the only ones who stuck to their guns about the overall bear market trend. So, Toreador, thank you for your comments. I really appreciate that. Let's bring Tony in. Kind of nice to get a little fan mail at the beginning of the show, huh, Tony?
Thank you very much. It made my day, Mike. It's been kind of rough for the last 2 weeks because if you remember, I was on the show 2 weeks ago, and I said a top was coming. And you said, "Are you going to go short tomorrow?" And I said, "Do you remember that conversation, Mike?"
Yes, I do.
And I said, "I will go short when the market tells me to."
Good.
It took 2 weeks to do that. So, one of the things as an investor is you need to test the market every once in a while. And one of the things that I noticed was that the Dow, the high of May the 1st, stayed with us for almost an entire 2-week period. And then last Thursday, it got overtaken by a new high. But that was interesting because what it did is it told me that the market was in flux and that things were about to change, but we just needed something. And apparently it might have been the PPI index this week. I don't know. That came out on Tuesday morning. But something in there just gave us a catalyst, and all of a sudden the floor just dropped out from under the market. And I was expecting it, but it was you might even say a little bit of a painful 2 weeks because when you test the market, you want to be right each time, but sometimes you have to sort of lick your wounds and pull back. You get stopped out of a position that you think is good in the beginning, and it turns out that it's not. So, that's the kind of thing you go through, and I've got clients that have gotten in touch with me from time to time in the last few days, as a matter of fact, and said the very same thing. Thanks for hanging in there. We realize that, you can go backwards a little bit, and that's allowable. Most clients don't think I'm perfect, and I don't try to let them know that. But at the same time, having that position, having a large worldview of the market, and as well as a good handle on the technical aspects are very, very important here.
I agree with you. And let's bring that first chart up. You've got I think it's the Dow Jones Industrials, and you've got it really nicely marked out. I'm going to let you go through this, and then I'll come up with some questions as you explain what we're looking at.
Well, this is an old chart. Actually, if you look at my former shows, you'll see it there a couple different times. And this is my bearish wedge that I was talking about. Bearish wedges are actually continuation patterns. They tell us that once the wedge is complete, that the pattern just prior to that wedge resumes again. And so what we had here was a situation where I could see the bearish wedge developing. It's been in development for a couple of months now, and there were months of declining market before the wedge developed. And so, one of the things that happened is we had 3 months of declining market and then the wedge, which took all of about 4 months. And the problem with that is people tend to be short-sighted, and they say, oh, the recovery's back again. And so, in fact, last week I couldn't make the program because I was at a roundtable conference with some other advisors, and one of the advisors openly admitted at this roundtable conference that he had just gone back into the market thinking it was safe again. And that's the problem with the market. It's like our cartoon. I don't know if you can bring this down or not, but the cartoon of Lucy pulling the football out from Charlie Brown, who's trying to kick it.
Don, Tony, Don, can we, there
you go.
Thanks, Don.
That's the market for you, folks, right there.
Not that one. That's another segment, Don. There. All right, let's go back to Tony.
That, in a nutshell, is what the market tends to do for people. And it just reminded me of it so much in the last week or so because I've been hearing comments. In fact, I've even had clients calling me last week saying, when are you going to turn bullish? For heaven's sakes, you're missing a big move. I'm going, no. This is bigger than you think, and it's not the direction that you think either. So the point is, this week we broke the bottom side of that wedge, and that means that now we're in for the resumption of the trend again. And let's talk about that a little bit.
Okay.
What happens next? First of all, this is most likely what we call an ABC pattern. An ABC pattern in Elliott wave talk means that the A wave down, which as we see, and I've got it labeled, although I believe my picture is a little bit off the edge of it there, that A wave, the reason I'm calling it an A wave is that it's not a clear 5-wave move. It looks more like an ABC down as well. So that would have a better label as an A wave. Then an ABC up. This is the B wave, okay? And that B is the top of the wedge. Now, in Elliott parlance, what happens is the A has a tendency. Now, please understand, this is not a rule. This is just sort of a guideline that the A wave, in a lot of respects, will have a tendency to be equal to the C wave. So, in other words, in the Dow, we had over 2,500 points. I think it was 2,564 points, top to bottom, down. And now we are in for another ride of at least 2,564 points again. So C equals A in an ABC wave. Okay? So that's point number one. Well, here's the problem. That ABC wave takes us to 10,572. Now, if everything stopped there, that would be wonderful. There's a lot of people that are saying we're going to stop somewhere around 10,600. A couple of very, very good analysts, by the way. They believe in the ABC wave, so that they've got it mapped out just the way I do. And they're saying, well, we're going to resume on to bigger and better things. The market, in other words, could go back up again. Well, here's the problem, Mike. The problem is, you see the red line across the bottom?
I do. That's a downtrend line. Go ahead.
That's right. That is called the neckline. So let's move to the next chart, and we'll define that neckline just a little bit better for us.
Okay, there we go.
Okay, now what we see here is a neckline. This is going back now to a much longer picture showing the 5 or rather 6 years of ascent. We broke the uptrend. That's very important to know. And this little trend line to the right, the upper right, or actually mid-right, right below the January lows and the August, actually the March lows from 2007. I call that the neckline. Now, some people have drawn it in a slightly different fashion. But you'll see the writing, if it's clear to our viewers here, the head and shoulders target now, that is a neckline for a head and shoulders pattern. The target for that pattern is 9,300. Whoops. In other words, if C equals A, the problem is we have now triggered the neckline of the head and shoulders pattern, putting that into action now, and giving us an even lower target. And so let's talk about this pattern for a minute. Now, please understand, we haven't activated the head and shoulders yet, and we could have a very, very puny C wave that just barely goes down to about 11,600, okay? And if that's the case, then on and upwards the market goes. So we could, as some people have envisioned this, we could stop at 11,600 and the market could be bullish again. However, Mike, the problem here is that C would be shorter than A, and that is a very rare event. So if C needs to equal A, then in fact, C waves are often much larger than A waves. They are a multiple of A waves. That is more often than fact than being less than equal to an A wave. So go ahead, Mike.
Well, my question was, when you say a multiple, just to give everybody an idea, is it 1.5? Is it 3 times? Is it 1.618, 2.618?
Right. You would use a Fibonacci retracement, and as a matter of fact, here's the interesting thing. We find that the 1.618 times retracement of or multiple of wave A takes us down to 9,000. Now, here's what's interesting. The head and shoulders pattern gives us a minimum target. That 9,302 is a minimum target for the head and shoulders. So if we look very closely here, a very common relationship would be a 1.618 multiple of A being equal to C, so that would bring us down to 9,000. So it doesn't matter, the head and shoulders target is not one of those etched in stone types of targets. It's actually just a minimum. It says this is how we have to go at least this far if we activate this. So once we go below 11,600, once we go down to 10,500, for example, this thing doesn't stop there. So the point here is, let's talk about that relationship for a minute. And here's one of the interesting things. If we measure from the October high all the way to that 9,000, we get a 31.5% retracement or a 31.5% decline, which, by the way, is an average. It's only average for the average 4-year decline that we've seen in the market every 4 years since 1896. So in other words, this is not an unusual pattern. And the problem is that we've gone so long since we've had it. The 2002 decline was over 38%, for example. The 1998 decline was about 24%. The 94 decline was very mild. It was only about a 13.5% decline. So when you look at these declines, you're only talking about averages, and half of the time the decline will be less than average, and the other half it'll be greater than average. So what we have here is a situation where that 31.5% is only average for what we've seen for the last 28 declines in the Dow, since 1896. Now, here's another interesting point. The total decline would also be not only 31.5% from the top, but it would also be a 38.2% decline of the entire Dow. From 14,400 to 9,000 is actually a 38.2. That's a Fibonacci retracement as well. And that's one of the things that we saw in the S&P, by the way, in that initial decline. That initial decline to the January low was also a 38.2% decline. The Dow didn't quite get that far. It was only about, I can't remember exactly. I know as a percentage it was about 19%. So this is what's interesting, is there's these Fibonacci relationships in the market that have a tendency to sort of direct where the market goes. Now, it doesn't matter that we hit the nail on the head. We can come close. We could get a little bit off the edge of the bullseye and still count this as a very good call here.
Right. Now, what about time frames?
Time frames right now, Mike. First of all, we have let me just warn people, the next 2 weeks are going to be very, very telling. And I believe that we should see a decline well below that 11.6% retracement, or excuse me, the retracement to 11,600.
Yeah.
Exactly. And I think that it's possible in the next 3 weeks that we could see the decline, the initial decline, to about 10,500 or so.
Okay.
I believe that could happen in the next 2 or 3 weeks. Then a bounce, and then the fruition or the balance of the decline coming sometime later in June.
Okay.
So, go ahead.
We're going to need to go to a break. On the other side of the commercials, let's pick up where we left off and then take it down the road for some more of these charts you send us, okay?
Thank you, Mike.
All right, we'll be right back. Tony Chernowski, Chief Investment Officer of The Practical Investor. I'm Michael Yorba, your host, here on Commodity Classics. Sit tight. We'll be right back.